When was the last time you actually let your money rest? Like, really rest. Not just letting it sit in a checking account earning 0.01% and calling it saving. Because let's be real, parking your cash where inflation eats it alive? That's not resting your money. That's neglecting it. Checking your portfolio every 20 minutes like it's a heart monitor. Not strategy. That's anxiety with a brokerage app. Jumping into whatever coin or stock is trending on Twitter because some guy with a rented Lambo told you to. That's not investing. That's gambling with extra steps. So today we're talking about something your money desperately needs, but you've never given it. Real rest. See, we live in a world that treats money the same way it treats people. If it's not moving, hustling, flipping, it must be falling behind. But here's what nobody tells you. The wealthiest people in the world didn't build their money by running it into the ground. They built it by putting it somewhere smart, and then leaving it alone. Your money doesn't need a side hustle. It needs a hammock. And by the end of this video, you'll know exactly how to build one. Let's be honest about what most of us actually do with our money. We let it pile up in a checking account. And I get it. It feels safe there. You can see it. You can touch it. It's right there when you need it. But that money isn't resting. It's rotting. If your checking account pays you 0.01% interest and inflation is running at 3, 4, 5%, your money is literally losing value every single day it sits there. That's not saving. That's watching your purchasing power shrink in slow motion. But then there's the other end of the spectrum. The people who think managing money means doing stuff with it constantly. You know the type. Maybe you are the type. Refreshing your brokerage app 12 times before lunch. Selling a stock because it dipped 2% on a Tuesday. Buying into the latest meme coin because your coworker's cousin said it's going to the moon. Moving money around from account to account. Platform to platform. Strategy to strategy. And at the end of the year, you've spent more on trading fees and stress than you've actually made. Here's the thing nobody wants to hear. All that activity, all that hustle, most of the time, it's not helping. It's hurting. Studies have shown that the more frequently people trade, the worse their returns tend to be. Not because they're dumb, because they're restless. They can't leave it alone. They confuse movement with progress. And then there's the third group, the avoiders. The people who know they should be doing something with their money, but the whole thing feels so overwhelming that they just don't. They keep telling themselves they'll figure it out next month, next year, after they get that raise, after they pay off that one thing, and next month turns into next decade, and the most powerful force in finance, time, has been ticking away while they stood still. So whether you're neglecting your money, exhausting it, or avoiding it entirely, the result is the same. Your money never gets to do what it was designed to do. Work quietly, grow steadily, and compound over time. Your money is tired. Let's fix that. So what does it actually look like when your money rests properly? Here's the key idea. Real rest for your money isn't doing nothing. It's putting it in the right place and giving it the time and space to grow without you constantly poking at it. Think of it like planting a tree. You don't dig up the roots every week to check if it's growing. You water it, give it sunlight, and walk away. Let's go through the options. The emergency fund, your money's bed. Before your money can go anywhere, it needs a safe place to sleep. That's your emergency fund. 3 to 6 months of living expenses parked in a high-yield savings account. Not your regular checking account. A high-yield savings account paying 4, maybe 5%. This is your financial foundation. It doesn't need to grow fast. It needs to be there when life throws something at you. A medical bill, a car repair, a sudden job loss. This money isn't lazy. It's on standby. Think of it as your money lying in a hammock with one eye open. Relaxed, but ready. Index funds, the slow walk. If the emergency fund is your money's bed, index funds are the slow walk through the park. Not flashy, not exciting. Nobody's making TikToks about buying an S&P 500 index fund, but here's what they don't tell you in those flashy I turned $500 into $50,000 videos. The most boring investment strategy in the world has outperformed the vast majority of professional fund managers over the long term. Not over 1 year, not over 5, over decades. An index fund takes your money, spreads it across hundreds of companies and says, relax, we've got this. You don't have to pick winners. You don't have to time the market. You buy in regularly, that's called dollar cost averaging, and you let time do the heavy lifting. That's your money resting, and it's working harder than most people's money ever will. Dividend investing. Money that pays you to sleep. Now this one is my personal favorite concept to explain. Imagine, your money is out there working a little part-time job, and every quarter it brings home a paycheck and hands it right back to the boss to buy more shares. That's dividend reinvestment. You buy shares in a company that pays dividends. Those dividends buy you more shares. Those shares pay more dividends. Those dividends buy more shares. And it just keeps going. It's a snowball rolling downhill. This is your money resting and reproducing. It's not doing anything dramatic. It's just quietly multiplying in the background while you go about your life. Bonds and treasuries. Sitting in silence. Bonds are the meditation of the financial world. Nobody talks about them at parties. Nobody brags about their treasury bill returns. But they serve a critical purpose. They're stable, predictable, and they balance out the volatility of everything else. Think of bonds as the part of your portfolio that sits in silence for 10 minutes while your stocks are out there having a panic attack. They don't make you rich fast. They keep you from going broke when things get rough. Boring? Yes. Important? Absolutely. Retirement accounts. Rest with a tax shield. Here's where it gets really interesting. Accounts like a 401k or a Roth IRA aren't just places your money rests. They're places your money rests and the government agrees to take less of it. With a traditional 401k, you're investing money before it gets taxed. With a Roth IRA, you pay taxes now, but never again. Not on the growth, not on the withdrawals and retirement. Your money is compounding inside a tax-protected bubble. That's not just resting. That's resting in a luxury suite. Real estate. Resting inside a growing asset. Whether it's owning a rental property or investing in REITs, real estate investment trusts. This is your money resting inside a physical asset that tends to appreciate over time while also generating income. A rental property pays you rent every month. A REIT pays you dividends. Meanwhile, the underlying asset is typically going up in value. Your money has a roof over its head, literally. The common thread through all of these? You set them up and you step back. You don't micromanage, you don't panic, you let time and compounding do what they do best. If resting your money is so effective, why doesn't everyone do it? Same reason people don't rest their bodies. It feels wrong. We've been wired culturally and psychologically to equate action with progress. If you're not doing something, you must be falling behind. And the financial world is the worst at this. Social media is full of people showing off their trading screens, flipping options, making it look like real wealth comes from speed and aggression. And it creates this feeling, this itch, that you should be doing more. That buy and hold is for people who don't know what they're doing. That if you're not actively managing every dollar, you're being irresponsible. But the data says the opposite. Study after study shows that passive investors, the ones who set up a strategy and leave it alone, tend to outperform active traders over the long run. Not because passive investors are smarter, because they're not sabotaging themselves with emotional decisions. Then there's FOMO, the fear of missing out. Your coworker tells you about some stock that went up 400% in a week. Your feed is full of people posting gains, and you think, why am I sitting here with my boring index fund while everyone else is getting rich? But here's what you don't see. The losses. The people who bought at the top and sold at the bottom. The ones who put their rent money into a meme stock and can't make the payment this month. Survivorship bias is real. You see the winners because they post about it. The losers go silent. There's also the illusion of control. When you're actively moving money around, it feels like you're in charge. It feels productive. But feeling productive and being productive are two very different things. Sometimes the most productive thing you can do with your money is absolutely nothing. And finally, and this one's important, a lot of people don't start because they think it's too late. Or they don't have enough. They think investing is for people with 6 figures in the bank. But here's the truth. The best time to start was 10 years ago. The second best time is right now. Even small amounts consistently invested can turn into something significant over time. You don't need a fortune to start. You need a plan and the patience to follow it. Alright, so how do you actually do this? Let me give you 4 practical steps. 1, schedule it. Just like you'd schedule a workout or a meeting, schedule your money's rest. Set up automatic transfers on payday. Every time you get paid, a portion goes straight to your investment account, your savings, your retirement fund, before you even see it. This is called paying yourself first, and it's the single most powerful financial habit you can build. When it's automatic, you remove the decision. You remove the temptation. Your money goes where it needs to go without you having to think about it. That's your money clocking into its rest shift like clockwork. 2. Protect it. Your money's rest is going to be interrupted. Life is going to throw temptations at you. A sale, a vacation, a once-in-a-lifetime investment opportunity from someone you met at a barbecue. Protect your money's rest the way you'd protect your sleep. Create boundaries. Keep your investments in separate accounts from your spending money. Give yourself a 48-hour rule before making any unplanned financial decision. If it still makes sense after 2 days of thinking about it, fine. But most of the time, that urgency fades. And so does the bad decision you almost made. 3. Experiment. Not every form of rest works the same for every person. And not every investment works the same for every financial situation. Maybe you're young with a high-risk tolerance. You can lean heavier into growth stocks and index funds. Maybe you're closer to retirement, and you need more stability. Bonds and dividend stocks might be your move. Maybe real estate excites you. Maybe you want to keep it dead simple with a target date fund that adjusts automatically. Try different things. See what fits your risk tolerance, your timeline, your goals. The important thing is to start somewhere and adjust as you learn. 4. Release the guilt. This is the big one. Stop feeling guilty for not doing more. Stop feeling guilty for not checking your portfolio every day. Stop feeling guilty for choosing simplicity over complexity. The financial media wants you to feel like you're not doing enough because that's what keeps you clicking, watching, subscribing to premium services, and buying courses. But the truth is, the most successful long-term investors are often the ones who do the least. They set a strategy, they fund it consistently, and they leave it alone. You don't win at investing by being the busiest. You win by being the most patient. Look, I know this isn't the sexiest financial advice. I'm not going to tell you how to turn $100 into $1 million by Friday. That's not how real wealth works. Real wealth is built the same way real rest works. Slowly, intentionally, and without guilt. You wouldn't run a marathon without sleeping. You wouldn't work 7 days a week and expect your body not to break down. So why would you treat your money any differently? Give your money a place to rest. Give it time to recover. Give it the space to compound, to grow, to work for you instead of being dragged around by every impulse and every headline. Your money doesn't need a side hustle, it needs a hammock. So go build one. And if this video helped you see money a little differently, hit the like button and subscribe to Wealth Logic. We break down the financial strategies that actually work, without the hype, without the noise, just logic. I'll see you in the next one.